If you want to make money from your investments, as in actually get regular income, then you need to understand everything there is to understand about distribution and accumulation share classes. Yesterday, we spoke about what stocks and shares are, and depending on the shares you buy, you can get a share of the companies you've invested in's profits. It's genuinely a beautiful thing. The more shares you have, the more money you receive. It honestly makes perfect sense. But there are two main ways in which you can be paid out when you invest in funds. Now, with the analogy we used yesterday, where individual shares are like books, stocks are a bookshelf full of books, and the stock exchange is a bookstore. A fund is like a company's recommended reading list of books. You can then buy shares in the fund created by those companies, and they fall into two main share classes: distribution or accumulation. Distribution funds pay out cash to you through dividends from the profits of the companies in their fund. Dividends are typically paid out into your investment account every quarter or twice a year if, and I do mean if, dividends are paid out on your shares or the fund that you have invested in. Because as we all know, profits really aren't promised, especially not in this economy. These funds are called distribution funds because they are distributing the profits among their shareholders. You see how that works? You can usually tell which ones they are because they have distribution, dist, or income next to the name of the fund or shares. Alternatively, you have accumulation funds which instead reinvest these profits, allowing you to accumulate more shares. If you want to really benefit from the effects of compounding when it comes to your investments, then accumulation funds may be something to look into. You can tell these funds by the accumulation or AC by the name of the fund when you look them up. But where things get a little interesting is when it comes to taxes. Because don't get it twisted, you will need to pay tax on all dividends and accumulations you make from your investments. Unless, of course, you were smart enough to hold your investments in a stocks and shares ISA or an SIPP, a self-invested personal pension. If you were smart and you used these special tax efficient accounts to invest in, then you wouldn't have to pay tax at all. But if you've used up all of your stocks and shares ISA allowance of £20,000 per tax year and you want to continue investing, or you choose for whatever reason to ignore the stocks and shares ISA and you invest using a general investment account, aka a GIA, then there is tax to be paid. Now, everyone has a dividend allowance, which is an amount that you can earn from dividends from distribution funds or accumulated income from accumulation funds before they are taxed at all, and that is currently £500 per tax year. After that, you'll be taxed according to your personal income tax band. Congratulations, day 2 of 30 investing terms you should know is complete. If they wanted to teach you, they would, but they won't. So I will. See you guys tomorrow for our next lesson.